Strong quarter, strong results, $2.3 billion underlying, mostly from a strong Rosneft result out of Russia. Good downstream result supported by oil trading, even though refining margins were slightly off this quarter versus the previous quarter, and a slightly lower tax rate than we were anticipating. So overall, it's actually given us a strong set of underlying earnings, but more importantly, strong operating cash, which has allowed us to stabilize debt this quarter, and debt is now flat quarter on quarter.
Obviously, the market was fixated coming into these numbers about the difference in where the headline oil price was a year ago compared to where we are now. In terms of what you're delivering here, how does that set up the path into fourth and then first quarter of next year?
Yeah, so we're about 11 quarters into what was a 20-quarter strategy. Oil prices have relatively stabilized right now around about $55 to $65 a barrel. They're pretty finely poised depending on what happens with US, China, Iran, Venezuela and US lower 48 production, but they seem to be sort of stabilizing somewhere around $60 a barrel. I think that sets us up well, given we got the company back into balance of $50 a barrel about 2.5 years ago. So therefore we start to generate more surplus cash. That surplus cash will help us pay down the debt, and that will then ultimately bring the gearing back into the 20 to 30% range where we started.
Do you want to talk to us about the CapEx program, though, in light of that lower oil price and obviously preparing for the future, talking about an energy solutions company down the track? Yeah. So what does the CapEx program look like at this point? Well,
CapEx was still driving deflation. It's coming off digitization. It's coming off technology. CapEx is still trending below 12 billion year to date. We're going to be somewhere below 16, which is the middle point of our range of $15 to $17 billion. We're continuing to see efficiencies in capital spend. So in some respects, that's helping even further with the balance point that I talked about earlier. But overall, we're not yet seeing any sort of capital inflation coming through. And if anything, we're continuing to drive deflation, particularly in the upstream numbers.
How difficult is this type of environment to try and plan around when we've got concerns around a trade war and what that does in terms of the demand story for oil? At the same time, we've got monetary policy question marks, whether we've got more easing from the Fed to shore up the economy. How difficult is it to plan over the next coming quarters then based on demand and how much free cash flow you've got to work with?
Yeah, ultimately it's about supply and demand. And if you look at where we are right now in terms of world oil stocks, so if you think about oil as a proxy for how well the company will be doing, oil stocks are right in the middle of the range, the historical 5-year range, and therefore all of these factors, they can dampen or put a little bit of juice under the actual oil price itself at the moment. It's actually not that difficult in terms of planning to go forward. The key is to make sure that we can control the things that we can control, which is the big major projects. We're about 2/3 of the way through now a major rebuilding of the company. If you think what we laid out in 2016 as our sort of strategy, we've now got 2/3 of those projects on stream and producing. They will ramp up and continue to ramp up through into next year, into 2021. And then we have a series of targets in 2021, which is basically set to generate significant free cash flow in terms of versus the amount of cash that we're spending around our capital program. So while it's difficult in terms of what's going on with US, China, demand has definitely got softer this year. We came into the year, demand was growing at 1.3 million barrels a day. By the middle point of the year, it dipped to 1 million barrels a day. Now it looks it could be as low as 900,000 barrels a day, maybe lower. That is pretty much being driven by the whole issues around China-US trade tensions.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.